Good afternoon to our esteemed investors and partners. My name is Sunny Lalwani. I would be the host for today's webinar on Golden Decade Fund. We have Mr. Kuldeep Gangwar, who is the fund manager for this fund portfolio. And Kuldeep brings in more than 2 decades of experience in equities. He has been associated with ASK, and before this, he has been part of HSBC Securities. He has built his expertise in consumer sector. The webinar would be divided into 2 parts. The first one, he would be taking us through the macro outlook, what is happening. We have seen the regime change in US. We have seen the earnings slowdown in last 2 quarters. What would be the impact on the portfolio and way forward? And then followed by the question and answer sessions. So my request is type in questions in the chat box. We would try to answer all of those. Thank you, Kuldeep. Over to you.
Good afternoon, everyone. Thanks for joining in. As Sunny mentioned, that we start with the global macro picture and it provides a context. So we have recently seen that Republicans have won US, and that's the reason they can be shift in the policy, especially related to energy trade and the non-trade. China has announced some monetary and the fiscal stimulus to address the concern of the slowing growth. We expect additional measures based on the policy change, which will be announced by the new dispensation in the US in the January 25. From say European economy side, the growth still remains subdued, and currently the global GDP is supported by US. From interest rate cycle perspective, we have seen that from almost September 21 onwards, there had been one-way up cycle for the interest rates. It's reversing now. So it's being started by, say, ECB, and now we have seen in last 2-3 months, US Fed has also cut the interest rate by 75 basis points. Geopolitical situation in Europe and Middle East continue to remain elevated. From overall market performance perspective, India had been relatively better performer, whether CYTD, whether 1 year, 3 year, 5 years. So one of the better performing market globally. For us, crude oil prices matter quite a lot because we are the large importer of the same. So good news is that they had been benign in a particular range of $70 to $80 in recent time. So there had been some spike as and when, say, some say tension, whether in Middle East or Russia, Ukraine flare up. But otherwise, from overall, say, current account deficit perspective and overall import bill of crude oil being concerned, it had been relatively more manageable. Domestic backdrop. So far, if we look how our own economy is progressing, so IMF had raised a GDP forecast by 50 basis points to 7%, and that would be the ballpark figure most of the people expecting in FY25. Food inflation continued to remain sticky and putting some pressure on the CPI, and that's the reason had been some hindrance as far as the rate cut is being concerned. So as far as the policy is being concerned, RBI has changed its stance from neutral versus withdrawal of accommodation, which signal that they can be calibrated easing in time to come. From fiscal deficit point of view, so far the number had been close to 30% of overall estimated figure of about 25. We expect in FY25, the growth should accelerate by increasing the government spending and the revival of export. First half was particularly challenging, especially from the capex perspective, because there had been multiple reasons, whether it's a general election followed by, say, extended monsoon. We do believe that the spending pattern should change, and second half should have some acceleration on the order inflows for many, say, capital goods companies, infra-related companies, and so on. Consumption growth had been quite mixed bag in recent past. Two-wheeler and consumer durable reported a strong number, while the other discretionary segment had some impact of the extended monsoon. We expect that second half should be relatively better for the discretionary consumption-related companies. Management have pointed out that rural recovery is happening, but at the same time, the challenge is that the urban demand had been subdued. So at one point, we are getting some comfort, but at the same time, there had been a drag coming from the urban side. For Q2 FY25 earnings, if we go segment wise or sector wise, so auto ancillaries, two-wheeler performed better, led by better volume growth and the margin expansion. At the other hand, passenger vehicle, commercial vehicle, tractors continued to experience the muted performance. Banking on and financial side, things were on expected line, like higher cost of fund continue to impact the net interest margin. Credit cost was slightly elevated, which impacted the PAT growth. Companies which are exposed to capital market activities witnessed the robust performance in alignment with the overall robust say market performance at least till September 24. Consumption side, there had been a mixed bag. Like we discussed that consumer durable did better, but at the same time, say FMCG staple had a relatively muted quarter. And invariably, everybody had pointed out that urban demand had been subdued while rural is recovering. Chemical and pharma company, we have seen that the destocking issue, supply chain issues is going on for quite some time, and it impacted, say, Q2 of Y25 performance as well. Expectation is that the second half onwards, there should be a volume recovery, which should be followed by some price recovery in time to come. On the engineering, industrial, and capital goods front, we have seen that extended monsoon and election had impact on the overall reported number by this particular sector. And as I mentioned earlier, that second half should be relatively better for these particular segments. Oil marketing companies, refining margin were sequentially impacted, along with some losses in the LPG business. Based over, say, current number, say, GRMs have improved, and say retail margin also remain better, which should help the overall earning growth in the second half. So the way we think about it, probably the worst is over in case of the OMCs. Pharma and healthcare, pharma company which are having relatively higher exposure towards the domestic market, they did relatively better. Domestic volume growth was stable, and lower input costs also helped in the margin expansion. Hospitals, we have seen some better numbers, like patient volume is steady, though there had been limited increase in the ARPO led by which essentially led to relatively muted growth, but operating leverage help in the overall margin improvement. From the valuation perspective, the current Nifty valuation would be quite close to the 10-year average, which the Nifty has seen. So after recent correction of almost 7 to 8%, valuation are relatively a lot more reasonable. ASK Golden Decade Fund and India Vision Portfolio. So we have analyzed the portfolio and its performance in last 2 years. And as we discussed in past, like in FY24, there were certain elements which had been dragged on the overall performance, like consumer discretionary chemical exposure, pull it down. In terms of financial exposure, there was selection of certain NBFCs which did not deliver the desired result. At the same time, we had limited allocation towards the PSU banks. And we have also mentioned that in FY24, PSU as a pool, though it had only 10% benchmark weight, but it delivered almost 90% return in FY24. So large part of, say, benchmark or BSE 500 return came from that particular pool. So we have taken corrective actions and tried to address the white spaces, and which have also started yielding the result. So we have increased our say contribution or say exposure towards industrial manufacturing, infrastructure, commodity part of it. And if we talk about say manufacturing, say Polycab, Defense, Bharat Electronics, in the capital good, Apar Industries, Transformer and Rectifier, they did relatively better. In other sector like telecom, whether it's a Bharti, commodity exposure which is coming through Gravita, Patanjali Food, Radico Khaitan, etc., also performed relatively better. So some of the changes have started yielding the result, and rest should be following in due course of time. In terms of focus areas, as I have mentioned that we have increased our exposure towards say infra and manufacturing because we believe the recovery of industrial capex currently is led by say government and the PSU spending. But at the same time, the strong corporate balance sheet and increased capacity utilization rate should help the private investment improvement. So we do believe the private capex should pick up. Focus on defense and railway overhaul has say helped those sectors. Another focus area for the government had been say power, energy transition, automation, and auto manufacturing, and which is well supported by say policy initiative like PLI, which also boosts the employment opportunities. We believe this energy theme, defense theme, railway theme, it's a theme for decades rather than for a year or two. On the other side, in the consumption space, we believe that focus on the bottom of pyramid should help, say mass-based system. At the same time, higher income should help better penetration in many discretionary categories. So discretionary consumption should also accelerate in years to come. These are the changes which are being done in last 6-7 months. So it's quite evident that we have increased our exposure towards industrial, material, and manufacturing side. So whether names like Apar Industries, Titagarh, say Gravita, KI Industries, Ramkrishna Forging, Transformer Rectifier, and so on. At the same time, we have exited many financial names, whether it's Bajaj Finserv, AU Bank, as well as say some of the other names like Reliance, Bajaj Paints, and other stuff. So one thing is quite evident that we are having significant overweight on say capex and investment theme. Almost 30% exposure is coming from that particular area. We still remain say overweight on the consumption side. Despite we have cut some exposure in those areas. In last couple of months, we have added Amcure Pharma. So Amcure Pharma is a pharmaceutical formulation company which account for almost 86% of the revenue. API is 6%, CRAM is the balance 8%. The company is having the balanced portfolio. 50% is coming from India, balance is coming from exports. And within export, it's almost everything coming from the non-US market. If we think about, say, prospect, the company has invested quite a lot in manpower as far as the manufacturing facilities, and the productivity of the same should improve in coming quarters and the coming years. As well as if we look at FY24, there were many one-off, whether it was some litigation-related costs, some acquisition-related costs, and so. So that's the reason we believe there should be accelerated growth in the top line, as well as there should be the margin expansion. So this probably would be among the few companies delivering say 20% earning growth from medium-term perspective. So if we look say Q2 delivery as well, 20% top line growth and almost 30% plus earning growth in the same. Second name which we have added is PDS Limited. So PDS is like a platform. On the one hand, there are the retailers like Walmart and others. And on the other hand, there are the textile manufacturing companies. So this company bring best of both the worlds and bring those guys at the same common denominator. So from say revenue exposure perspective, almost say 70% of the revenue is coming from UK and European Union. North America is close to 13%, Middle East is close to 14%. North America is a market where they are investing quite heavily. Like FY24, they invested almost 100 crore. FY25, the similar sort of investment will be happening in North America. So we believe that North America market should be having relatively higher contribution in time to come. So in terms of say overall expectation, we believe that this company can deliver almost say 20% revenue growth in medium term, as well as the margin expansion should also happen. So on the earning perspective, we believe that this company can deliver 30% plus earning growth for a near to medium term. This is a snapshot of, say, evolution of our sectoral exposure. So one thing is quite evident that over a period of time, we are constantly increasing our infrastructure and engineering exposure. So last year, March, if we used to have close to 14% coming from that particular area, as on October end, almost 29% weight is coming from, say, infrastructure and engineering. Consumption, I mentioned, though we have cut some weight, but it still remain uh, reasonably overweight. Balance is coming from, say, financial, automobile. We have also added the commodities in form of, say, Gravita. It's a more of a call on the recycling sector. In the healthcare, we have added the position of Amcure along with the existing position of Mankind over there. So overall, say market cap breakup, almost 45 to 50% weight is in the large cap. Balance is coming from mid and small. So quite a reasonable allocation in all the three segments. Q2 FY25 earning. So our portfolio delivered almost 19% earning growth, with Nifty delivering close to 7-8% over there. And this had been the constant, say delivery coming from the portfolio. Like whether we look FY24 or we look even prior, the earning growth had been delivered on the ongoing basis. So even in FY25, we expect almost 20% plus earning growth vis-a-vis single digit in Nifty. In FY26, again, we expect 28% plus earning growth. And this is a point like the earning growth had been delivered on the ongoing basis and there had been no exception, and we expect the same even in time to come. The thing which has changed, this chart represents a trailing valuation of the portfolio. So current valuation are on the lower side vis-a-vis say what we have observed in last 4 years. So as it happened, like portfolio return are combination of two things, like what is happening to earning growth and what is happening to, say, valuation side. So in last couple of years, earning growth had been delivered, but at the same time there was significant multiple derating, which pulled down the overall stock performance or say portfolio performance. Today, where we stand, we believe that scope for further valuation derating look relatively lower, because what is changing, uh, September 21 onwards, the interest rates were rising, and when it happened, it's a negative news for, say, growth stock, growth sector, and growth style, and which was resulting in, say, overall multiple derating. Today, we are talking about the reversed scenario, and probably the interest rate cut may be a tailwind for the growth style as such. In the base case, even if we assume that valuation remain where they are, theoretically the earning growth should translate into the stock return, and that is something which we are anticipating, that earning growth should remain robust, and if the multiple remain stable or say not have the similar derating what we have seen in past, there should be a decent say recovery in time to come. This is the psychographic, currently valuation, forward valuation of the portfolio is close to 27, and earning growth I have already articulated that it should remain 20% plus growth in coming years. So when we think about, say, attribution, the stocks like Radico Khaitan, Mankind Pharma, Transformer and Rectifier, Gravita, Vedant Fashion have helped the portfolio, while at the same time, Astral, REC, Indian Oil, Titagarh had been a drag. So, if I have to mention that in last 5-6 months, particularly, there had been some muted announcement from, say, either railways or capex side or the government side, which probably should change in coming 6 months or the year, because the election is behind as well as say monsoon is behind. So we expect the recovery on this particular part. And so we are quite hopeful that the things which have not worked so far should start contributing in time to come. This is a snapshot of the return. Like we had some recovery in last 3 months, relatively more stable vis-a-vis say overall market. And from the full year financial year perspective, still there is some gap. But given we have made many changes and some of them have started yielding the say result as well, we expect say better outcome in coming quarters and the year. I will stop over here and happy to have any question which you might be having.
Yeah, participants, I would request to put in your questions in the chat box. We will try to address those. So one of the questions, Kuldeep, is that we have seen after a long time, as far as earnings growth is concerned, in last 2 quarters, we have seen a slowdown. In fact, in quarter two, after COVID, this is the second quarter we have seen a single-digit growth. So will that put an impact as far as the overall numbers for this financial year is concerned?
So first we should look from where that lower earning growth is coming. So this particular financial year, if you look oil and marketing companies, they had been a drag on either the benchmark performance or our own portfolio earning growth. So if in Q2 of FY25 we talk about if we include OMCs, the earning growth was muted, like low single digit or so. If we exclude OMCs, the earning growth was high single digit or so. And similar is the expectation for the full year about 25 as well. Like if we include OMC, where we have seen, say, decline in earnings, the overall reported earning growth may be mid single digit for Nifty. If we take rest of the market, like exclude the OMCs, the overall earning growth can be double digit. From FY26, when so-called drag from the OMCs is already in the base, we expect again the earning growth should be 15% plus for the market, and in our case, it should be more than 20%. So, and if we talk about OMCs, I have already spoken, like in Q2, there was a drag coming from weaker GRM margin as well as say LPG related losses over there. As we speak, say GRMs have improved, and at the same time, marketing margins are relatively better. So Q2 probably was the worst case possible for the OMCs, and probably Q3 onwards, the thing should improve. Second, another big pool was where I have already mentioned that government has announced close to 11 lakh crore capex for FY25. In the first half, the things were relatively muted, and it had more to do with say Q1 having say general election related impact, and Q2 had say extended monsoon. We believe the pickup should be there in the second half, and that's the reason the overall number delivery should be better in this particular aspect. Second, if we think about consumption, so first half, again, there was hardly any marriage dates, wedding dates available, which impacted many discretionary sector companies. In second half, the thing should reverse. So we are quite hopeful that many discretionary sector consumption companies should deliver better result in time to come. So what we have seen, it was a drag coming from a particular sector and probably a blip in the overall story. And we are quite hopeful that from second half and about 26 onwards, we should have relatively stronger earning growth trajectory for the overall market as well as our own portfolios.
Yeah, thank you. So the second thing is that we have seen a lot of talk in the market as well about the FII selling, which has been intense in last 2 months. So in October, we saw 1,13,000 crores of FII selling. Although it reduced in November, but it was substantial number with more than 40,000 crores. Can we see that reversing in the near future? And your thoughts on that? I mean, one of the factors was like Chinese markets was looking attractive because of the stimulus packages. But what's your take on this whole story which has panned out?
So the way we think about it, like incremental flows will be having a lot of bearing basis what's going to happen in January 25 when the new US dispensation is in place and basis the policies they are going to implement. So currently market is having a lot of concerns related to say tariff barriers, say how the trade will play out. what is going to be the implication of those tariffs, etc., on rest of the world and its impact on the currencies. So think from the perspective that any FI would be thinking the US denominated return. So if the currencies become weak vis-a-vis US, the USD denominated return will be relatively lesser. So that is one of the thing. And second part is like it will be all contingent that what is going to be say the policies of US government for their own local market. If they are cutting a tax rate, it may give a boost to local earnings and so on. So we are going to have some sort of uncertainties for 2, 3 months. So that had been one of the reason that we have seen that it's outflow from emerging market as a pool, and a large part of the money had moved back to say US, and this is quite evident in say UST or US ETFs over there. At the same time, we believe that our local fundamentals are going to play a key role. If we are able to deliver on ground in terms of the earning growth, we are quite confident that probably a stability should come. And recently, we have seen that some recovery coming from, say, overall market perspective. Uh, you mentioned about say China thing, so it had already played out, and today it was not about India versus China. In fact, it was more about everything moving back to US. So uh, many things will be all contingent how say US policies play out in January onward. But at the same time, as long as our own fundamentals are strong, our earnings are coming. As I mentioned in the beginning itself, India had been relatively better performer, whether 1 year, 3 year, 5 year. Probably India will be, say, better performing market even in, say, future, apart from, say, US for that matter.
Thank you, Kuldeep. One of the question is you also highlighted on the performance slide where although we have in a short term has performed better than the benchmark, but if we look at 1 year, 3 year, 5 year returns, what the investor is asking is that it has lagged the benchmark in a big way. So why the investor should stay invested? What's the way forward you are looking at for this strategy
So two
in
things I
terms of
mean.
outperformance?
So two things I mentioned, like from the style perspective, like anybody following this quality and growth style had some disadvantage in the rising interest scenario. And now we are talking about reverse of that particular scenario. So probably say a style perspective, say quality and growth should have its time in coming quarters in the coming years. That's one part. Second, I mentioned like earning growth was not an issue. Like it came in FY24, it came in last 5 year, and we believe this is going to continue as well. And I mentioned there are two factors which decide the overall outcome as far as the returns are concerned. One is the earning growth, second is the valuation. So earning growth was not an issue. Valuation derating did happen because of multiple reasons, including say interest rate rising. And probably when we are talking about the reverse of it, like interest rate coming down. So in a base case scenario, I will like to believe, say, valuation may remain where they are. In fact, there is a possibility if everything goes right that there can be, say, a re-rating to some extent if the interest rate cut sharpens. But nonetheless, we believe that base case scenario, the probability that valuation de-rating happening further is relatively lower. So theoretically, future returns should be driven by, say, earning growth, and we are quite confident the earning growth should be there, and it had been delivered in past and it should continue to happen in future as well. And I have already articulated like what sort of earning growth we expect in years to come. So the way we think about it, probably whatever say happen in past, we should expect many of those say factor have already played out, and we should have relatively better outcome in coming quarters and the year.
Okay. Some of the, as you highlighted in your presentation as well, some of the new entrants like Apar Industries, Gravita has performed really well. But some of our old stalwarts like Bajaj Finance, if I talk about APL, Apollo, or Titan, they have been bit subdued. Although if you look at the commentary of APL, Apollo, they said that next 2 quarters would be much better in terms of earnings growth. If you can stock specific wise, if you can give the rationale about what to look forward for these companies in the portfolio.
So the way we think about it, like Bajaj Finance and Finserv is quite similar sort of exposure. So if you look entry exit, we have exited from Bajaj Finserv. So it's almost like we have brought down our Bajaj Finance exposure by 50%. Because if it's a largely similar weight situation, if we exit from one of the name, then probably it's like bringing down the exposure toward that particular name. This is despite the company delivering, say, consistent better performance within its own space. And we expect that when it comes to delivery, probably it is going to be among the only few names which can deliver say 20% to 25% NII growth and similar sort of funding growth. And valuation have also come down materially. So here onwards, though we remain confident from the delivery perspective, at the same time, from risk control perspective, we have brought down our exposure. Second, you mentioned about, say, APL Apollo. So APL Apollo, obviously, there had been multiple reasons they were delivering volume growth, but at the same time, metal prices coming down drastically in recent quarters. The same volume growth did not translate into, say, operating profit growth. Uh, with the expectation that stability coming on that particular area, we expect that both volume growth as well as, say, profitability should be there in coming quarters and the coming years. So our expectation is that if we think about 26 and compare it with, say, about 24, we expect within 2 year on time frame the earnings should be almost double. Though there had been some challenges in recent say quarters, but we expect it's a more of a blip in the overall story rather than anything changing dramatically over there from a structural attractiveness perspective. Third, you mentioned about Titan. So Titan, we are having close to 2% weight. We have brought down exposure of Titan also over a period of time through the profit booking. And from the Titan point of view, there are two, three things are happening. Like Q1 FY25, say gold prices were quite high. And that's the reason it had impact on, say, overall, say, volume growth, sales growth. Q2, we have seen that there was custom duty cut. And that's the reason there was all of a sudden volume growth and value growth pickup, but it had negative impact on the margin because the custom duty is paid in advance. So we have seen Q2 FY25 almost 290 crore negative impact of the custom duty cut, and we expect similar sort of number in Q3 as well. But from longer term perspective, one thing is for sure, because of the custom duty cut, which has come down from 15% to, say, 6%, uh, we believe it's a good news for the overall organized sector. So this transition from unorganized jeweler to organized should accelerate, and that is going to be the bigger driver and probably having a lot more, say, comfort factor in that particular aspect. And unorganized is still two-thirds of the overall, say, jewelry market. So the duty cut, though it's having negative impact on Q2 earning or Q3 impact, which is pulling down overall FY25 earning, but at the same time, it's ensuring that the transition from unorganized to organized should accelerate. And that's the reason from a, say, top line growth perspective, we remain quite confident. And in Q1, Q2, as I mentioned, when there had been challenges, so there had been a lot of increased competition, and which led to some lower margin vis-a-vis the Titan's own delivery in past. And these activities should also, say, become more rational when the demand scenario is relatively more benign. So FY25, if I think about it, there are many one-off which are either coming from extreme volatility in the gold prices, its impact on, say, custom duty, its impact on the earning. But FY26 on the normalized base, we will like to believe there is a potential to deliver mid-teen to high-teen, say, top line growth and the earning growth. And at the same time, as I mentioned again, that we have brought down our exposure significantly. Now it's close to 2%. This is about time.
Yeah. So we have a couple of companies in our portfolio from FMCG space, and what we had seen that there has been some slowdown as far as the urban consumption is concerned. So there has been a talk that rural consumption would be back, but how it impacts the numbers of FMCG companies going forward in that sense.
So from FMCG perspective, we have only Patanjali, which you can say come in the typical staple definition. Otherwise, we have the exposure of Varun Beverages, we have the exposure of Radico Khaitan, and both the companies have delivered number on the ongoing basis. So whether it had been history or it's a recent past or coming years, earning had been delivered by both Varun and Radico Khaitan, and we believe that that number should remain quite strong. Like in case of Varun Beverages, we expect the earning growth should be more than 25% CAGR for at least 2 to 3 years. And Radico Khaitan, we expect the earning should double within 2 year time frame. So we have a exposure more towards the discretionary consumption rather than the FMCG part of it. We have only Patanjali over there. Patanjali should also deliver a pretty decent number. One thing, their own existing business as well as the consolidation of the say HPC portfolio, like personal care portfolio, will be happening from this quarter onwards. So which should also help the Patanjali delivery. So net, our consumption side of the portfolio have delivered decent earning growth and should expect the acceleration in the earning growth in time to come. Broader consumption, I have already mentioned that because of say extended monsoon, the part of the consumption got impacted. And second, like say edible oil prices increase, which had some bearing on say cost inflation for many food FMCG companies over there. As you mentioned that rural is having some recovery, but at the same time that the benefit was offset by say slowdown in urban. So those challenges persist and probably may continue to have the overall FMCG growth in overall earning growth point of view. So, but in as far as our portfolio exposure is concerned, it's more discretionary and our confidence level for earning growth delivery is quite strong over there.
Thank you. Also, we have exposure in Adani Energy and Adani Port. So recently, what we have seen, the news coming in from US, also it has been denied by the company. What's your take on that? Although we continue to hold the both the businesses, if you can throw some light on these two companies which we are holding in the portfolio.
So first of all, like how much we are holding. So we are having close to 3.5% weight in Adani Port, and second close to 2% weight in Adani Energy. So combined weight is close to 5.5%. We have seen that negative development happening from the news flow perspective of the group. At the same time, if you look these companies in isolation, if we talk about Adani Port, it's the largest port operator in the country, having the real estate representative of, say, infra story of our own country and having aggressive expansion, say, history as well as the future prospects. So from fundamental side, we believe that the number had been there and will be there. Second is Adani Energy. Adani Energy is basically combination of transmission, distribution, and smart meters. We believe that earnings have started improving, and we expect almost 20 to 30% earning growth in this particular business. So Adani Port, more stable business and having earning growth potential of 15 to 20%. On Adani Energy side, it's more 20% plus earning growth expected. So from fundamental side, we remain quite say confident that the earnings will be delivered, and these companies hold the real assets having the real value. At the same time, because of the correction, the valuation have become a lot more reasonable, and we have seen in past that these negative development happen also in past as well. But right now the details are quite sketchy, so we will be waiting say how the overall say clarity emerge in that particular area, and we will be having our own deliberation. But as we speak, that from fundamental side, we remain quite comfortable that these companies have delivered in past and should continue to deliver, say, earnings even in future as well. So this remain on the watch list area, but at the same time, we currently believe that on ground delivery should remain intact.
Okay, thank you. Also, we have exposure in Titagar Wagon. So you highlighted after some pause. So we saw in this week itself the government cabinet has approved projects close to 8,000 crores. So should we see a consistent, like we were seeing in the earlier about the focus of the government on sectors like railways?
So, as I mentioned in the beginning, like manufacturing, defense, railway, this is not a theme for a year or two. This is a theme for decades. And this railway modernization should continue to happen. Titagod story was more freight wagon in the past, and it's changing. Today we are talking about say private coming into the picture, whether it's coming through the metro, whether it's coming or say modernization coming through Vande Bharat, etc. So the nature of the business is evolving. So we believe whatever happened in last 6 months in terms of order inflow, etc. It's more of a blip in the overall story. And railways probably continue to have relatively better activities, higher activities for many years to come. And Titagarh is among the leaders over there. And they are also evolving, like they are adding the new business streams, and which should help the overall cost. So we remain quite hopeful that the scenario for the overall sector should improve in coming quarters and the coming years.
Okay. Anything on the financial companies? There also we have seen some sort of slowdown we had seen. So anything on that front, how much quarters it would take for these companies to make a comeback?
So
Banks
during
specifically.
during the presentation in the beginning, I've said that many things are happening on the expected line. Like there is some increase in the cost of funds, and when it happens, it's having negative implication for net interest margin. The credit costs also increase, and particularly in certain segments like MFIs, etc. At the same time, we have said in past that any economy does require a good financial systems, and um, so whether it's banks, NBFC, this are a purpose. And if you talk about our exposure, whether it's coming through Chola or say Bajaj Finance, um, earning had been delivered on the ongoing basis, whether 1 year, 3 year, 5 year, 10 year, and we believe that the future should be also similar, at least from the direction perspective, and probably they should be in the top quartile as far as the say earning growth in their respective domain. So from delivery perspective, it's not an issue. Valuation have come down significantly in the overall BFSI space, and a lot more reasonable, a lot more comfort factor coming from the valuation perspective. So net our exposure, whether it's NBFC or in the bank side, we have the SBI Bank, which had relatively better number vis-a-vis say other peer group. So when it comes to valuation, probably this is one area where the valuation are a lot more compelling. When it comes to delivery, there had been some challenges in recent quarters because of whether it's elevated credit cost or say some compression of the name. But as and when the things is stabilize, in terms of future, we expect a low to mid-teen earning growth happening in the overall sector, and in our own exposure, we expect almost 20% earning growth. And the next exposure we are having through the REC. So REC is more of a call on the energy transition, like whether it's a traditional power and energy, or it's a renewable investment happening over there, because almost 30% of the REC book will be coming from the renewable side. So loan growth we expect should be mid-teen to high-teen for the REC. Valuation is still quite compelling, close to 1.5 price over book value. So two things, like from earning growth perspective, we expect a decent delivery in years to come, in combination with a lot more reasonable valuation vis-a-vis past.
Thank you, Kuldeep. Can't see any other question in the chat box. So thank you so much for addressing on the portfolio about what's the way forward it would be. and also on the individual stocks as well. Thank you so much.
Thank you, everyone. Have a good day.